Hey there, fellow investors. We're about to unlock the secrets of technical analysis. Forget the boring balance sheets and income statements for a minute. We're diving into the exciting world of stock charts. Trust me, charts don't lie. They tell a story about supply and demand, fear and greed. Learn to read these stories and you'll be well on your way to making smarter investment decisions. Whether you're a seasoned pro or just starting, understanding the basics of technical analysis can give you an edge in the market. It's like having an extra set of eyes, helping you spot trends, identify potential buy and sell signals, and navigate the often turbulent waters of the stock market. So, buckle up, grab your favorite charting software, and let's get started. Technical analysis is like reading the tea leaves of the stock market, but instead of tea leaves, we use charts and indicators. It's all about studying historical price and volume data to identify patterns and trends that can help us predict future price movements. Think of it this way. Every time someone buys or sells a stock, it leaves a footprint on the chart. By analyzing these footprints, we can get a sense of where the stock might be headed next. Technical analysts believe that history often repeats itself in the market. By recognizing these repeating patterns, we can potentially get ahead of the curve and make more informed trading decisions. Now let's talk tools. Every profession has its essential tools, and trading is no different. Just like a carpenter needs his hammer and saw to build a house, a technical trader needs the right tools for the job to navigate the markets effectively. Don't worry, we're not talking about anything too complicated here. You don't need a PhD in finance to get started. We'll stick to the basics, the bread and butter of technical analysis. These are the foundational tools that every trader should be familiar with. First up, we have moving averages. These are essential for identifying trends over different time periods. These are like trend lines on steroids. They smooth out the price data, making it easier to spot the underlying trend. By averaging the price over a specific period, moving averages help you see the bigger picture without the noise of daily fluctuations. Then we have the Relative Strength Index, or RSI. This is a momentum oscillator that measures the speed and change of price movements. This nifty indicator tells us if a stock is overbought or oversold, like a gas gauge for the market. It helps you gauge the market's current state. And let's not forget about support and resistance levels. These are critical for understanding price action. These are like the floor and ceiling of a stock's price movement, areas where the price tends to bounce off of. Recognizing these levels can help you make better trading decisions. These are just a few of the many tools at your disposal. The world of technical analysis is vast and full of possibilities. The key is to find what works best for you, your trading style, and your risk tolerance. Everyone's approach can be unique. Experiment, explore, and don't be afraid to try new things. The more you practice, the more proficient you'll become. Section 4. Charting your course. Reading stock charts. Now that we've got our tools, let's learn how to use them. Understanding stock charts is crucial for making informed trading decisions. Reading a stock chart might seem intimidating at first, but trust me, it's like riding a bike. With practice, it becomes easier and more intuitive. Once you get the hang of it, it becomes second nature. You'll start to see patterns and trends that were invisible before. First, look at the candlestick patterns. These are the building blocks of stock charts. These little guys tell you a lot about the battle between buyers and sellers. Each candlestick represents a specific time period and shows the opening, closing, high, and low prices. A long green candlestick means buyers were in control, pushing the price higher. A long red candlestick? Sellers were in charge that day. The color and length of the candlestick can give you a quick snapshot of market sentiment. Then pay attention to the volume bars at the bottom of the chart. Volume is a key indicator of market activity. High volume confirms the price movement. When you see a price move accompanied by high volume, it means there's strong interest in that stock. Think of it as the crowd cheering for the winning team. Finally, connect the dots. Look for patterns, trends, and signals. These can help you predict future price movements. Are the moving averages crossing over? This can indicate a change in trend. Is the RSI flashing red? This could mean the stock is overbought and might be due for a pullback. Is the price breaking out of a resistance level? This is often a bullish signal. These are all clues that can help you make more informed trading decisions. By understanding these elements, you'll be better equipped to navigate the stock market. Section 5. Avoiding common pitfalls. Don't fall for these traps. In this section, we'll explore some of the most common traps that traders fall into and how to avoid them. Technical analysis is a powerful tool, but it's not foolproof. It can provide valuable insights, but it should never be the sole basis for your trading decisions. Like any skill, it takes practice, patience, and discipline to master. Consistent effort and learning from your mistakes are crucial for long-term success. And just like any journey, there are bound to be some bumps along the road. These challenges can be learning opportunities if approached with the right mindset. One common mistake is relying too heavily on just one indicator. Remember, diversification is key. Using multiple indicators can provide a more comprehensive view of the market. Use a combination of tools to confirm your signals. This approach can help you make more informed and balanced trading decisions. Another pitfall is ignoring the bigger picture. It's easy to get lost in the details, but always keep an eye on the overall market trends. Don't get so caught up in the short-term noise that you miss the long-term trend. Balancing short-term and long-term perspectives is essential for successful trading. And finally, don't let your emotions get the best of you. Emotional trading can lead to impulsive decisions that are often regretted later. Fear and greed can cloud your judgment and lead to costly mistakes. Staying calm and rational is crucial for making sound trading decisions. Remember, trading is a marathon, not a sprint. Success comes from consistent effort over time, not from quick wins. Pace yourself, stay disciplined, and never stop learning. Continuous education and self-improvement are the keys to long-term success in trading. Section 6. Case Study. Apple Inc. AAPL. Let's bring it all together with a real-world example. Apple Inc. AAPL. Imagine you're looking at AAPL's chart back in early 2023. The stock had taken a beating, down over 25% from its all-time high. But wait, look closer. The 50-day moving average is about to cross above the 200-day moving average, a classic bullish signal. The RSI is also showing signs of life, climbing out of oversold territory. Fast forward to today, March 7, 2025. AAPL has been on a tear, up over 50% from its lows. Those who recognized the bullish signals early on were handsomely rewarded. This is just one example of how technical analysis can help you identify potential investment opportunities. Section 7. Keep learning, keep growing. Congratulations! You've just completed a crash course in technical analysis. But remember, this is just the beginning. The world of trading is constantly evolving. New indicators, strategies, and techniques are emerging all the time. Don't be afraid to experiment, to challenge the status quo, and to keep learning. The more you know, the better equipped you'll be to navigate the exciting and potentially profitable world of stock trading. Now go out there, put your newfound knowledge to the test, and remember, bulls make money, bears make money, but pigs get slaughtered.